Welcome to today's episode of PolicyCast. In this episode, we will discuss important tax and regulatory developments impacting India's fintech and digital growth ecosystem, ranging from the ongoing reverse flipping wave and IPO readiness of startups to concerns around startup tax incentives, angel tax litigation, and depreciation claims on acquired intangibles. Over the last few years, several Indian origin startups such as Flipkart, PhonePe, Meesho, and Razorpay have either completed or initiated reverse flips to India ahead of IPO plans, despite significant tax costs and restructuring complexities. At the same time, fintechs and DPIIT recognized startups continue to face uncertainty around tax holiday eligibility, angel tax legacy disputes, and the treatment of acquired workforce or intangible assets in acquisition transactions. To discuss these developments and what they mean for founders, investors, and the broader fintech ecosystem, we have with us Manish Khurana today. Welcome, Manish.
Thanks, Shilpa, for inviting me to the podcast. And I really thank all the audience which is part of this and listening to this. So, yeah, please tell me whatever you want me to speak upon and we can continue from there.
Yeah. So, reverse flipping has become one of the biggest themes in the digital growth ecosystem. Why are Indian startups suddenly moving their holding companies back to India?
Yeah, so this is a development. More so, I would not say it's a recent development. It's a development which has been happening for some time now. So what happened was that over the last decade, many Indian startups had incorporated in various jurisdictions, being Singapore, US, because the global investors preferred offshore structures because of various reasons, be it regulatory flexibility, easier fundraising, tax certainty, and listing opportunities outside India.
Mm-hmm.
However, that trend is now changing. Companies, as you mentioned in your initial thought, companies like Flipkart, PhonePe, Meesho, Razorpay, they have either completed that reverse flip to India or they have initiated those discussions or initiated that entire reverse flip requirements.
Okay.
So the key driver, I think, which is there in around this is the IPO readiness for the Indian capital markets, because our markets have matured significantly over last few years. So founders, investors, everybody says a very strong valuation potential within India itself. And this entire thing has been supported by a few changes which have happened. In September 24, Rule 25A was amended to simplify the inbound mergers. Frameworks have been more flexible than earlier. So these restructurings, which could take years earlier, their times have reduced substantially. So that is why overall the startups are trying to align their legal structures with their actual businesses, customers, employees, and revenues which are located in India essentially. So that is the reason why this has become one of the biggest themes for companies operating in digital growth ecosystem. And that is why we are seeing so many conversations around these things.
Okay, so that clearly shows how these capital market dynamics are influencing corporate structures.
Yeah, definitely, because a lot of these startups have been funded by private equity, and the ultimate idea is to get listed and raise money. So that is why these flexibilities are leading to these discussions.
So my next question to you is on there's one issue which is being discussed frequently in the startup ecosystem is the loss of Section 80 IAC or the Section 140 under the new Income Tax Act. These benefits when DPIIT recognized startups shift to the concessional tax regime. Why is this becoming a concern?
So we have also dealt with, I would say, examining this issue for some of our, I would say, clients. In that sense, this is an important issue, but slightly overlooked in the entire, I would say, how the gravity of the situation is looked at. Because if you see the 80 IAC section of the erstwhile Act, and if I talk about the new Act, Section 140 of 2025 Act, that section provided DPIIT recognized startups with 100% deduction of their profits for 3 consecutive years out of the 10 years from their incorporation. Now, this deduction is not available if the startup opts for a concessional corporate tax regime under Section 115 BAA, which now is Section 200 of the 2025 Act. So many startups actually continue under the normal tax regime because they are either loss making or because they intend to utilize Section 80 IAC benefits in their most profitable years. So as businesses scale and pressure for structures which are more tax efficient increases, companies opt for concessional tax regime. The problem is that once they migrate to concessional tax regime, most of the deductions, including the deduction under 80 is no longer available. So they actually enter into a phase of uncertainty where in their later life cycle, they are faced with a genuine dilemma. And that is something which most of the startups have to evaluate, that whether they want to continue under the old tax regime to preserve this tax holiday because that means paying taxes at a higher rate, or they move to concessional tax regime for lower rates but then risk the availability of these deductions. So the way this entire deduction is structured, the way that section reads, is creating this dilemma for companies, and so the long-term profitability projection for these companies, tax modeling becomes very important when these decisions are being taken. So that is the entire issue, and that is why it is being discussed frequently in this entire ecosystem.
So clearly, tax planning for startups is no longer short-term. It requires a life cycle approach. And even where reforms have been introduced, some legacy issues continue to linger.
So I would not call it the legacy issues. Just to close this point, we can't call it the legacy issue, but this particular issue is more how this section is drafted. I believe the idea was to give genuine benefits to startups, but the way this section reads as of now, that is creating some, I would say, dichotomy in the entire structure.
Okay. So, although angel tax provisions have now been abolished, startups still appear worried about legacy litigation. Why is this issue continuing?
So this essentially continues because while this amendment which was put in was welcomed by the entire ecosystem, the practical reality is that for the earlier years, because the amendment when it came was more prospective in section 56(2)(7)(b). So since it is a prospective amendment, for the earlier years when the section was still in force, tax authorities have been scrutinizing the funding rounds and the valuation at which funding happened whenever the assessments take place. And that is why this issue, while the section has now been abolished, still remains a legacy issue. And what is causing concern is that in a few cases, the valuations at which the funding happened are being actually challenged using a hindsight approach, or taking into account the subsequent actualized performance of the company. Now that is where the problem comes in, because obviously when the funding happens in a startup, right, that is forward-looking based on the risk capital assumptions, how technology would function, what is the market opportunity. So that's not only limited to assessing or doing a valuation based on present profitability. And that is why adopting that hindsight approach after a few years creates these problems, because it may so happen that the projections are based on a few assumptions, and later on the company may or may not have performed to that level. But then that is something which is a benefit of hindsight, which was not available when the funding actually happened. So this entire approach is creating some problem. So while the angel tax has gone, this ecosystem still faces some uncertainty from the ongoing disputes. And the larger concern, how it can be addressed, is that even going forward, while the section is not in place, the valuation method which is being adopted should be based on commercial rationale rather than other things. So that is what it is, but still remains a legacy issue.
Okay, so this highlights how valuation, despite being commercial, remains a contentious tax issue.
Yeah, it does. For the past year, it does.
Yes. So another interesting controversy relates to acquired workforce being treated as goodwill or intangible assets during acquisitions. Can you please explain the issue?
Yeah, so in various, I would say, acquisitions which are happening in the fintech ecosystem or the digital growth company space, when the acquisition happens under the accounting treatment, which is governed by Ind AS 103, a part of acquisition value is attributed to various intangible assets, being customer relationships, technology, brand value, and also the assembled workforce. Now, from an accounting standpoint, acquired workforce is recognized as goodwill. However, what we have seen of late is that the taxpayers have contended that acquired workforce falls under the category of other business or commercial rights of similar nature, which is one of the categories which entitles you to depreciation. And on the other side, tax authorities have argued that workforce is not a separate identifiable depreciable asset, and therefore depreciation should not be allowed. So many such claims have been a issue of contention between the department and the taxpayers. And recently, Delhi Tribunal, in one of the cases, which is TV Today Network, has delivered a favorable ruling saying that acquired business rights include acquired workforce and therefore may qualify for depreciation. So this is very relevant for fintech and digital growth companies because value for these companies substantially lies in their human capital, engineering capabilities, and platform integration. So this is a new issue which is now coming up. It is at a very initial stage, I would say, of litigation. But given that it has huge revenue implications, department may actually carry on the matter to higher forums against some of the judgments which, as I mentioned, have recently come. So this would remain a developing area of litigation as things move forward, and it could significantly impact how acquisition structures are drawn in this entire ecosystem. So essentially a space to watch out for as we move forward.
Okay, so that's clearly an area where judicial clarity will be crucial going forward. And given the stakes involved, this could significantly influence deal structuring.
Yeah, it would. And as I said, this is a very interesting space to follow and see how it develops over a period of time.
Yes. So the digital growth companies often run aggressive marketing campaigns, spending cash to acquire and retain users. But we are seeing disputes where tax authorities treat these as brand building activities and seek to capitalize them. What's happening in this space?
So again, a very practical issue for digital first businesses. So if anybody who knows about these type of businesses would understand that customer acquisition and retention in this space is very, very competitive. Users keep on moving between various apps, they chase better offers, and they may not be staying at a single platform. So companies are required to run continuous marketing campaigns, be it cashbacks, referral bonuses, promotional discounts, to keep them engaged, to keep them at the platform. And from the company's perspective, it is a routine recurring expenditure because it is something which they are required to incur year on year. And it's like any other cost of doing business in a very, very competitive market. So in their opinion, there's no enduring brand or asset which is getting created. And therefore, companies normally take a position that this is a revenue expenditure entitled to deduction under the Income Tax Act. However, tax authorities have continued to take a different view. They believe that this builds brand equity in the long run and therefore should be capitalized as an intangible asset and maybe entitled to depreciation, but should not be charged as a revenue expenditure in the P&L account. So the challenge for the taxpayers is to demonstrate that campaigns are not creating any lasting benefit and they actually represent day-to-day operational cost in a market where things are very transient. So what becomes critical here is robust documentation, that in order to justify this claim, in order to say that it is something which is a revenue expenditure, companies are required to maintain evidence to show that the nature and the frequency of the campaign, the competitive context, the churn rates. So all this is required and should be documented properly to ensure that they get a deduction for this and demonstrate that all this is not leading to any enduring asset creation. If I talk about how litigation has been in this area, at appellate level, taxpayers have received relief in several cases, but at the assessment stage, the issue still remains contentious. So digital growth companies are required to be proactive, both in how they document these expenses and how they present the commercial rationale during assessments to make sure that they can get these deductions and get these claims at either at the assessment level, or if not there, at least at the appellate level. So that is what this issue is all about.
As we conclude today's discussion, it is clear that India's fintech and startup ecosystem is entering an exciting and transformative phase. Whether it's reverse flipping, evolving tax regimes, legacy disputes, or emerging issues around intangibles and marketing spends, The intersection of innovation and regulation is becoming increasingly complex. For founders and investors, the message is quite equally clear. Tax and regulatory strategy can no longer be an afterthought. It must be integrated into long term business planning and deal structuring. Thank you, Manish, for sharing your insights and helping us decode these critical developments. And thank you to our listeners for tuning into PolicyCast. Stay with us as we continue to bring you conversations that matter for the future of policy, business, and growth.
Thank you. Thanks.